So today we're going to be looking at interest rate parity conditions and basically how we can use those to predict forward rates. And in addition to that, we're going to use the unbiased forward rates hypothesis to look at the relationship between forward rates and also expected spot rates, which enables us to come up with a prediction for what those spot rates might ultimately be. So far we've looked at several parity conditions. We've looked at purchasing power parity, which has really had two different types of conditions here. We've had relative purchasing power parity and absolute purchasing power parity. We've looked at the Fisher effect, and that Fisher effect established a relationship between real interest rates, nominal interest rates, and inflation. And it basically asserted that the nominal interest rate is the real interest rate plus the inflation rate. Then we looked at the international Fisher effect. That international Fisher effect basically took the PPP relationship, applied the Fisher effect, and then tried to establish a prediction for what future spot rates might be. Now next we'll need to look at two different relationships here. Interest rate parity is one of those relationships, and interest rate parity basically gets at the idea that there might be a relationship between nominal interest rates and forward rates, for forward exchange rates that is. The unbiased forward rates hypothesis basically looks at the idea of these forward rates being an unbiased predictor of future spot rates. That is, the expected spot rate is equal to this forward rate. And those are the things we're going to look at the moment. So we can see that diagrammatically here. This is interest rate parity condition. It's establishing a relationship between interest rate differentials and forward rates, in particular forward premiums or forward discounts over the current spot rate. We can then use the unbiased forward rates hypothesis to make predictions about what the spot rate might be in the future, i.e. that expected spot rate at some future time period. So previously what we've looked at is other relationships. So for example, we've looked at relative PPP. Relative PPP establishes a relationship between exchange rates and inflation rates. And it's basically saying that the change in the exchange rates is going to reflect the inflation rate differential between two currencies. So for example, say our exchange rate is expressed as home currency over foreign currency, then the exchange rate differential, so the exchange rate at time t divided by the exchange rate at time 0, is going to be equal to the ratio of their inflation rates. So 1 plus the inflation rate in the home currency divided by 1 plus the inflation rate in the foreign currency. So that's effectively what relative PPP is saying. So we can look at how this might tell us things about future exchange rates. And it's basically saying, say we want to predict foreign exchange rate. Our exchange rate at time t, so at some future time period, that's going to equal our current exchange rate multiplied by our inflation rate differential. So here the inflation in our foreign country, either expressed as foreign country over home country or home country over foreign currency as the case might be, divided by the other inflation rate. So say for example we're looking at the US per Australian exchange rate. That is how many US dollars you get per Australian dollar. In that case you would take your current exchange rate, so your E0, multiply it through by 1 plus the US inflation rate, divide through by 1 plus the Australian inflation rate. And that would give you a prediction for the spot rate in some future time period. This is sometimes approximated as well. So we can sometimes approximate our percentage change in the exchange rate over one period as just the difference in the inflation rates, i.e. the difference in the inflation in the US and the inflation in Australia in this particular example. Now to be clear, this is an approximation. It's not truly accurate. It's an approximation and it's only going to work to some extent. And even then it would only work for A, small levels of inflation, and also B, one period. It would not be accurate for multiple periods. It would not be accurate for high levels of inflation. And even then, for those small inflation rates and for one period, it isn't going to give you a perfect answer. It's just going to give you an approximation. So it is an imperfect proxy for what the percentage change in the exchange rate might be. We also looked at real exchange rates. Now, real exchange rates are basically getting at the idea of what happens when we deflate an exchange rate for inflation differentials. So over time, inflation reduces the value of money, i.e. it is a contributor to the time value of money here. So what we might want to do is we might want to deflate an exchange rate to reflect those inflation differentials. So to do that, say we want our real exchange rate as at time t. Here that's expressed as E dash. We take our nominal exchange rate, so that is our market exchange rate. Then we multiply it by, again, an inflation differential or an inflation fraction but you have to be careful to make sure you use the correct numerator and the correct denominator. So here, for example, say we're looking at the US over Australian exchange rate. Then you multiply through by 1 plus the inflation in Australia and divide through by 1 plus the inflation in the US, i.e. is the opposite of when you have a relative PPP. So it's important to bear in mind you have the numerator and the denominator the correct way around when you're calculating your real exchange rates. So far we've looked at relative PPP. We can then move on to the Fisher effect. Now the Fisher effect was another way of relating exchange rates to interest rates in this case. That would be under the international Fisher effect. To get there, we need to first go to the Fisher effect. The Fisher effect is basically creating a relationship between real interest rates, nominal interest rates, and inflation rates, and is basically saying that the nominal interest rate, or 1 plus the nominal interest rate, is equal to 1 plus the real rate multiplied by 1 plus the inflation rate. So you have that multiplicative relationship here. It then ultimately ends up collapsing into this expression we have on the slides here, where our fraction of our inflation rates is equal to the fraction of the nominal interest rates. And this is under the heavy assumption that real interest rates in the economies are equal to one another. If those real interest rates are not equal, then obviously this relationship would not hold. So to see how this works, assuming our real interest rates are equal across countries, and also assuming we have this relationship where 1 plus the nominal rate is equal to 1 plus the real rate multiplied by 1 plus inflation, then we can rearrange these things. The reason for this is under that relationship here, where the nominal rate is 1 plus the real plus 1 plus multiplied by 1 plus the inflation, we can rearrange that. So 1 plus the real rate is equal to 1 plus the nominal rate divided by 1 plus the inflation rate. But if the real rate is equal across all of these countries, then that would mean that we have our fraction. So 1 plus the nominal rate over 1 plus inflation is also equal across all the economies. We can then rearrange this fraction as we've done here, basically multiplying and dividing through both sides. So our nominal rate fraction here is equal to our inflation rate fraction. So what that means is we end up with an implication for future exchange rates. And we can also approximate this by saying the nominal interest rate difference is approximated by the inflation rate difference. Again, that's an approximation and is under the heavy assumption that the real interest rates across countries are the same. So if we look at the international Fisher effect, the international Fisher effect starts with our relative PPP relationship. Then it notes that this inflation rate differential is exactly equal to our nominal rate differential. So then we can just substitute it in, and we effectively end up with our exchange rate fraction is equal to our nominal interest rate fraction. So here, this is expressing our exchange rate fraction. Our predicted exchange rate at time t would equal our current exchange rate multiplied by the fraction of the nominal interest rates. This then moves us on to our relationships that might relate forward rates to perhaps nominal interest rates. In this case, interest rate parity. So interest rate parity basically works in the same underlying goal and underlying premise as the international Fisher effect. It asserts that there shouldn't be an arbitrage relationship where you can get a different return from investing abroad versus investing at home. And particularly interest rate parity looks at what situations can arise where you have effectively eliminated this risk that you would otherwise get from investing abroad. Put differently, when you've eliminated risk, then you should have a no arbitrage relationship. And you can eliminate risk through the use of forward contracts. And we'll see how that might work. So this interest rate parity relationship basically tries to get at the idea that the forward differential that might arise is going to equal our interest differential. Now, if you recall the international Fisher effect, it asserted the returns from investing abroad should equal the returns from investing at home, and these should be equal when expressed in a common currency, basically meaning that exchange rates should be set so those returns are equal. Interest rate parity extrapolates this, and in particular we're focusing on what happens when you have access to forward rates. So you'll recall from international Fisher effect that the return from investing at home should be equal to the return from investing abroad once you've expressed things in this common currency. So under covered interest rate parity is working on the same premise, but we're locking in our exchange rate. And effectively this is a hedged or locked in exchange rate here. It's called a covered interest rate parity because you're using a forward rate to effectively eliminate risk. So you'll notice here you've got your return from investing at home, which is in this case risk-free. You have a return from investing abroad, which is also in this case risk-free. Now we also notice here that when you've used this forward contract, you've effectively eliminated the risk of the exchange rate fluctuating over time because you've locked in the rate with the forward contract. So the return from investing at home should be equal to the hedged return from investing abroad. So that's effectively what covered interest rate parity is asserting. Now, notably here, this forward rate is something that we know and can determine at time zero and is always going to give us that exchange rate that we've locked in. Now, if you recall, the forward rate, or forwards in particular, are the obligation to buy or sell the underlying asset at the predetermined price at a predetermined date. So it's effectively an obligation that is going to arise and is going to lock in an exchange rate. Hence why we also have this idea that a domestic investment can be replicated by combining a foreign investment with a forward contract which locks in our exchange rate. Furthermore, it implies that when we rearrange this equation, the forward rate should equal our current spot rate multiplied by our nominal interest rate differential. So in particular, if we're expressing the exchange rate as the home currency of the foreign currency, we take our current exchange rate, multiply it by 1 plus the nominal rate in the home country, divide through by 1 plus the nominal rate in the foreign country, and take these all to the power of the number of years. So let's have a look at the steps that might arise here, and you'll see how these give rise to the same return. So say, for example, you start off with the Australian-US exchange rate. So you borrow $1 Australian today, and you're going to repay a certain amount in the future. You'll repay 1 multiplied by 1 plus the nominal rate in Australia. So 1 plus our Oz Australian dollars in a year's time. You then sell your Australian dollar to get a certain number of US. Now, if our exchange rate here is expressed as US over Australian, then we're going to get ET numbers of US dollars. And when we've got ET numbers of US dollars, we can then invest those. And when we invest them, we'll get ET multiplied by 1 plus the nominal rate in the US, i.e. ET multiplied by 1 plus our US in this case. Now, what we then do is we've got a forward contract, and we've used our forward contract to sell forward the US dollar. So we've sold forward ET multiplied by 1 plus our US numbers of US dollars. So we've done the forward contract here. So that's going to give us ET, or ET divided by F multiplied by 1 plus our US as the amount of Australian dollars we end up getting back. So we end up with that expression right down here as the number of Australian dollars we end up with. And because there's no risk in this relationship, this means that the return from Australia, i.e. 1 plus R Australian, has to equal this relationship, this ET divided by F multiplied by 1 plus R US, because there should be no arbitrage arrangement in this situation. So in the absence of arbitrage, we'd end up getting zero profit from engaging in that transaction, i.e. the return from both of these is equal to one another. i.e. the return from this investment in the US should be equal to our return from investing in Australia. And we can also rearrange these equations to get our forward rate, or a fraction of our forward rate, to our current spot rate. So for example, down here, we've got the forward rate over the spot rate is equal to our nominal interest rate differential, i.e. 1 plus R Australian divided through by 1 plus R US. In this particular case, depending on how we're expressing the exchange rates. Now, ultimately, whether we're using Australian or US on the numerator or denominator is going to depend entirely on how our exchange rates are expressed. So let's have a look at another example here. So suppose, again, in this case, we have the nominal rate in the US is 3%. The nominal rate in Australia is 5%. The current spot rate is 68 US cents per Australian dollar. The forward rate is 66.7 US cents per Australian dollar. Let's look at what approaches and what steps we're going to take. So first we might borrow 1 Australian dollar. Then when you borrow 1 Australian dollar, you sell that Australian dollar to get 68 US cents, i.e. 0.68 multiplied by 1. You can then invest that. So you invest it and you get 0.68, and you then bring that forward and you invest it, and you're going to get 0.68 multiplied through by 1 plus 0.03, i.e. multiply it through by 1.03. You've then used your forward contract to sell forward that 70.04 cents that you'll get from your investment. You then sell forward and you get back Australian. So you get back Australian, in this case, 1.05 Australian dollars. You then use it to repay the Australian dollar borrowing that you had. And ultimately, in this case, we'd end up with zero profit because we're assuming there would be no arbitrage opportunity. So basically, a domestic investment can be replicated with a foreign investment plus a forward contract, as I've already expressed here. Now we can simplify this grossly and basically say our ET divided by F multiplied by 1 plus the rate in the US is equal to 1 plus the rate in Australia, where we've just substituted in numbers into our relationship that we've seen before. So in this case, when you put these in, you'll end up with that relationship. The forward contract is equal to the spot rate multiplied by 1 plus the Australian nominal rate divided through by 1 plus the US nominal rate. Now, we have to note here as well that if the hedged return doesn't equal the domestic return, then we'll end up with an arbitrage opportunity. So for example, if the return in the US is below the return in Australia, then people are going to flood into Australian dollars, and that will ultimately drive up the Australian dollar. Conversely, if the return in the US exceeds that in Australia, when you've done the currency conversion, of course, then funds are going to flow into the US rather than into Australia. Over time, those arbitrageurs are going to force the relationship to hold. So basically, what we're going to have is arbitrageurs forcing our equality to hold. Interest rate parity rather, implies that there's no covered interest arbitrage opportunities. No arbitrage opportunities that you can exploit just by using a forward rate and the interest rates that are available. So that's effectively what our current covered interest rate parity relationship implies. The forward rate is equal to the spot rate multiplied by our nominal rate differential, where in this case, we've got our exchange rate expressed as home currency over foreign currency multiplied by 1 plus the nominal rate in the home currency divided through by 1 plus the nominal rate in the foreign currency. Now, uncovered interest rate parity is a situation where we don't use the forward contract. It's a situation where our position is not covered. In that case, we're still going to have risk, so you wouldn't truly have a no arbitrage relationship. However, uncovered interest rate parity states that the expected spot rate is equal to our current spot rate multiplied through by our nominal interest rate fraction here. So it's the same basic relationship, but instead of the forward rate, we're looking at the expected spot rate. Now, interest rate parity in reality tends to hold at least to some extent. The reason for this is arbitrageurs are generally going to try to eliminate any arbitrage opportunities. And if there's riskless profit that can be made by investing these currencies at the nominal interest rate and using a forward contract, then clearly arbitrageurs will do this. But of course, there can be barriers to it actually being operationalized. These can involve default risk if you don't believe that the counterparty is going to pay on your investment. They could include political risk that might arise from investing in a foreign country. They might involve capital controls that prevent you from being able to repatriate money into your home country. And there could be taxation differentials that give rise to barriers to actually implementing this. In addition to this, if there's a forward contract, to some extent there can be default risk that can arise. Futures contracts largely eliminate that default risk, but forward contracts are still to some extent exposed to it. You can get deviations from covered interest rate parity, however they tend to be relatively minor and relatively short-lived. So we can kind of see that around the Lehman Brothers failure, that there were deviations from the covered interest rate parity, but they were largely due to those large systematic changes at that time period. In general terms, it's going to hold reasonably accurately over time. This then leads us to the unbiased forward rates hypothesis. The unbiased forward rates hypothesis basically asserts that the forward rate is a good predictor of expected spot rates. So that's effectively what it's implying. Our forward rate is equal to our expected spot rate, and that's going to give us a way of predicting what our spot rate is going to be. Now, unbiased doesn't mean that it's perfectly accurate. Unbiased means that on average, the forward rate is equal to the spot rate in the future. So we're basically just getting a predictor here. In any given time, you will get random fluctuations that mean the spot rate does not exactly equal the forward rate that you lock in. And that's going to be quite usual. All we need here is that it's unbiased, meaning the expected value is equal to our forward rate, i.e. the forward rate gives us an idea of what on average our spot rate is going to be. So if we look at this and bring it all together, covered interest rate parity says our forward rate is our spot rate multiplied by a nominal rate fraction. Uncovered interest rate parity asserts that we use our expected spot rate instead. Now, if we're going forward and then using the unbiased forward rates hypothesis, that implies our forward rate is equal to our expected spot rate. So it's basically creating a relationship or a bridge between our covered interest rate parity and our uncovered interest rate parity, basically telling us that these two relationships should hold, if that unbiased forward rates hypothesis actually were to hold in reality. Now, unbiased forward rates hypothesis, to some extent, is going to be relatively useful. To some extent, it is going to be accurate, but it's not going to be perfectly accurate. Basically, with this unbiased forward rates hypothesis, the forward rate over time is likely to give rise to a good or reasonable prediction of the expected spot rate, but it's not going to be perfectly accurate at any given point in time. And in general terms, it doesn't account for a risk premium that might arise when you've got risk-averse investors. In particular, risk-averse investors might be willing to pay a premium for a forward because they're able to avoid risk. And the unbiased forward rates hypothesis doesn't fully account for these. So it doesn't properly account for that risk premium that might otherwise arise. And in general terms, that risk premium can easily exist. So unbiased forward rates in reality are generally going to be an approximation, but not perfectly accurate. Large errors can exist, but on average, they should cancel out over time. And we should bear in mind that there can be risk premiums that exist. Empirically unbiased forward rates hypothesis doesn't hold up perfectly well. And that's because there can be profitable carry trades, so profitable investments across borders that might exist. And this in part could be due to different risk premiums or similar things that might arise over time in different currencies. Or because structural breaks in the currency might arise that enable one to profit. In particular, if you're able to accurately predict central bank interventions, that might enable a profit to be achieved. So to give you an example of a really basic example here, a really basic carry trade, so say we've got a situation where the yen per US spot rate is 100 yen per dollar. The 3-month forward rate is 99.17 yen per dollar. Now we can look at what is the annualized forward discount. Now that forward discount we can easily get by the forward rate minus the spot rate divided through by the spot rate. Now that's going to give us a discount over our time period, our 3 months. So in this case, that's 99.17 minus 100 divided through by 100. If we want to annualize it, of course, we're then going to need to take the number of days we've got. So we're assuming a 360-day convention. That's the assumed number of days in a year in these forward contracts. We divide through by the number of days in our particular forward contract, and that's going to give us an annualization factor. So here, 360 divided by 90. And that's going to give us, in this case, an annualized forward discount of 3.32%, i.e. we've got our forward rate going down over time. So we get this forward discount. One could potentially exploit that depending upon the interest rates that exist across these two countries. So in which case, where would we buy the US dollar and where would we sell the US dollar? Well, say we have yen. It would appear that the yen would be more valuable in the future. So we'd probably want to buy the yen forward rather than buying the yen at the moment. The reason for that is in the future, you get more dollars per yen, or alternatively get fewer dollars per yen. Fewer yen per dollar rather. So buying US is cheaper in the forward market, and therefore you'd prefer to buy US in the forward market here. Put differently, you're able to capture a discount. In this case, a discount of 0.83%, meaning that you'd be probably better off buying the yen in the forward market, buying the dollar in the forward market rather. So unbiased forward rates in reality, like I said, large errors can exist, but should cancel out over time. Profitable carry trades can exist, and to some extent they can exist and do exist and can be exploited. But naturally, those are largely going to be exploited by large hedge funds, so it can be quite difficult for individuals to exploit them. Now, this can still be consistent with market efficiency if we've got risk premiums existing and time varying risk premiums. Because you have time varying risk premiums, these returns should not necessarily perfectly equal one another. Put differently, you should get different returns in different currencies if they're differently risky, i.e. if a different country has a different level of risk associated with it, or if you require a risk premium for investing in these things, or you get a risk discount for taking on the forward rate, then you're going to have carry trades existing. So that's going to be our carry trade relationship, and in particular, our unbiased forward rates hypothesis, and how that unbiased forward rates hypothesis relates to interest rate parity and enables us to establish a relationship between forward rates and expected spot rates. Now, currency forecasting is sometimes also done. Now, currency forecasting is slightly different, but is related to what we've just talked about. Currency forecasting generally involves trying to develop a model to forecast future exchange rates. This successful forecasting model would ideally have several characteristics. So it might give rise to superior results. It might attempt to use information not yet incorporated by the market. It might attempt to exploit small or temporary deviations from equilibrium, which is of course easier said than done. Or it could try to predict government intervention in foreign markets or foreign exchange markets. But of course these are not always straightforward. So it's unlikely to be sustainable to be able to exploit things the market doesn't know about, because as soon as we identify it, someone else could easily do so. The small temporary deviations are likely to be, unsurprisingly, small and temporary, meaning the profits one can exploit from them are going to be relatively short-lived and relatively small, and potentially exploited by algorithms before we get a chance to do so. And predicting government intervention is obviously quite fraught, and in particular knowing exactly how that intervention is going to influence the market is obviously another issue entirely from merely predicting that intervention to begin with. So these market-based forecasts, these are forecasts that are basically based on trying to predict what's going to happen to the market, i.e. using interest rates or inflation or various other things. Those can be problematic because we don't necessarily know what's going to happen firstly, and secondly, anything that's currently incorporated or currently known will be incorporated and reflected by other traders. So this is what our unbiased forward rates hypothesis is kind of implying, that we're able to get a good prediction for spot rates. So forward rates might be a predictor for spot rates, according to this unbiased forward rates hypothesis. Now this to some extent obviously is going to give rise to a somewhat reasonable prediction, but obviously people are going to try to exploit arbitrage opportunities. So the profits that can be obtained from this are going to be limited. Furthermore, we've got relatively few forward rates that will be for more than 1 year. People might also try to exploit things like inflation rates. Now, exploiting inflation or interest rates is obviously fraught because A, those are already known by the market. So by virtue of market efficiency, exchange rates should already incorporate those inflation or interest rate differentials. Additionally, there are some issues where we've already seen that the interest rates, or the exchange rates rather, don't fully express and fully reflect the exchange rate we'd predict according to inflation or according to interest or whatever the case might be, i.e. PPP doesn't always hold at any instantaneous point in time. So for that reason, we won't necessarily be able to use interest rates or inflation to necessarily predict forward exchange rates with perfect accuracy. In addition, investors might actually require different returns on domestic versus foreign investments, notwithstanding being able to use these exchange rates and these characteristics to try to predict currencies. Furthermore, the model will become increasingly complicated because we would need to include interest, inflation, GDP growth, and myriad other macroeconomic factors that A, are already incorporated into prices anyway, and B, are potentially unknowable in terms of how many factors might influence the exchange rate. Technical analysis might also be used. The aim is to try to discover patterns and try to trade based on those. Generally, it's done via charting or trends. Often it's done for day trading rather than long-term, because long-term myriad other macroeconomic changes come in and interfere with the chart that you'd previously set up. So it typically be done over a short time horizon where you're not going to get central bank involvement or structural changes that might influence how much return you ultimately get. And you can see that sometimes it doesn't result in good predictions. So if we take a little box here, you can see that there are myriad different characteristics or technical factors that you can identify. We've got support and resistance lines, we've got various trend lines, but if we just focus in on those, we can identify those characteristics. But when we zoom out, it's quite random, and either side of this little box, you'll get various changes that aren't necessarily consistent with what's inside, meaning the technical analysis can often be identified ex post, but won't necessarily give rise to good ex ante trading predictions, and in particular will be bad over the long term. Now, as I've indicated, you can get model-based forecasts. This would typically be done through a regression analysis, so a multivariate regression where you predict your currency change as a function of various other macroeconomic factors, which might involve relative inflation rates, interest rates, economic growth, etc. These would be put into a multivariate regression, and then you would use these to predict forward what might happen into the future. Now, these models can become very complicated, and as I've indicated, according to market efficiency, many of these already known factors should be reflected in exchange rates. So the utility of using some of these historical factors might be somewhat limited if they are already incorporated. Now, when we're evaluating these models, it would typically be based on the profits that can be made by trading on the model and also its forecast accuracy. So if you're trying to use the model to make a profit, you would want to both A, accurately identify what the exchange rate change might be, and then B, be able to exploit that profit after you've taken into account transactions costs. Now, these good models are obviously going to make better predictions than bad models. Oftentimes, these models don't perform better than necessarily just putting the numbers into a random number generator, basically just having a random walk where the exchange rate will move in a random manner. So many of these models ultimately don't end up working out particularly well, particularly since many of the factors that go into them should already be reflected in prices due to market efficiency. So if we summarize what we've looked at today, we've got covered interest rate parity, which is basically a relationship between forward rates and nominal interest rates. We've got uncovered interest rate parity, which is basically relating expected spot rates to the relationship between the current spot rate and also those nominal interest rates. Basically like covered interest rate parities, but instead of forward rates, we're using expected spot rates. Unbiased forward rates, we're basically saying the forward rate is a good or unbiased predictor of future spot rates, i.e. the expected spot rate is equal to our forward rate. Now, in some cases, it can hold over the long term, but it's not necessarily going to hold at any instantaneous point in time, and there will be deviations from it due to things like risk premiums. We also talked about some of the issues with currency forecasting, some of the issues in terms of using technical models and also using fundamental models like multivariate regression models, where you put multiple factors into a regression and how you would evaluate these. We also talked about the concept that if market efficiency holds, there's a limit to how much value you'd get out of using currently known factors to predict exchange rates. So that's our lecture for this time. It looks at various factors that might give us a prediction for future spot rates and for exchange rate changes. I hope this has given you some idea of how you'd go about using these, and I hope this video and this lecture have been useful to you. Thanks very much for tuning in, and I hope to see you for future lectures.